What occurred? Silver stopped acting like a sleepy metal and began trading like a strategic resource. We observed physical bids jump above paper pricing. We observed east versus west premiums spike sharply. And we observed the futures curve invert in a way that usually only emerges when supply is constrained. And if you think that's just a weird year-end glitch, stay with me, because the signals we received in late 2025 are pointing directly into a highly explosive 2026. Hey everyone, John A.G. here, and today I want to present the 5 biggest reasons I believe silver has a legitimate chance to be one of the most important markets to watch in 2026, and why those who wait for confirmation often end up buying after the easy gains are already gone. We'll cover supply, we'll cover governments, we'll cover futures market warning signs, we'll cover central bank policy, and we'll cover the type of volatility that shakes participants out just before the move they expected. And then I want to leave you with 2 questions that I truly want your thoughts on, because the comment section is where we can share insights in real time. Now, before we start, do me a small favor. If you enjoy straight, no-nonsense breakdowns like this, subscribe, 1 tap. That's it. Because 2026 is going to move rapidly, and you don't want to miss the critical weeks when silver signals what it's about to do. All right, diving in. When reviewing 2025, many people will recall the headlines, but markets don't respond to vibes. They respond to outcomes. And the outcome for silver in 2025 was dramatic. It was among the top performing assets of the year, up roughly 146%. That kind of gain forces a question. Was 2025 the blow-off top, or was 2025 simply the wake-up call? Because in metals, the largest moves frequently come after the crowd notices, not before. And what makes silver different from many hot trades is that it isn't just a story. It's a bottleneck. It's a material that gets used, consumed, and fought over. So let's start with reason 1, which is the foundation for everything else, a structural deficit. That's a clean term for an uncomfortable truth. Demand exceeds supply, and the gap must be filled by drawing down above-ground stockpiles. For roughly 5 years, silver has been in deficit, where the total pull from industry and investors surpasses what mines and recycling deliver. So what happens? The market doesn't magically create extra silver. It pulls from inventories. It taps stockpiles held by institutions. It leans on whatever above-ground metal exists to bridge the gap. But stockpiles aren't a permanent solution. They're a buffer and buffers shrink. And here, yes, where it gets risky for anyone who thinks prices can AT rise because the price already rose. When inventories shrink, remaining holders become more reluctant sellers. They don't want to part with metal at yesterday's price because scarcity changes behavior. In a surplus market, sellers chase buyers. In a deficit market, buyers chase sellers, and the entire game becomes what price convinces someone to give up what they have. That's why structural deficits tend to create a ratchet effect. Each wave of demand hits a higher wall, and silver has an extra complication. A large portion of demand is tied to real-world use. Electronics, solar, medical, industrial processes. And these uses don't politely pause because a chart looks stretched. A manufacturer either secures supply or loses output. Losing output is often more costly than paying a premium. So structural deficits don't simply resolve because commentators want them to. They resolve when price becomes painful enough to ration demand or when new supply finally arrives. And that takes time. Which brings us to reason 2, sovereign demand and control. This is where silver stops being just another commodity and starts being treated like a strategic input. In 2025, the United States designated silver a critical mineral and added it to the official critical minerals list. That may sound like paperwork, but critical has meaning in policy. It means the government considers supply essential. It means supply chains matter. And it means the metal is now evaluated through a national interest lens, not just an investment lens. And once that occurs, the playbook changes because governments do not act like retail traders. They don't buy because a chart looks attractive. They buy because they want control and resilience. Now, alongside the U.S. reclassification, we saw clear indications that Russia is allocating spending toward precious metal reserves that include silver. Whether it began as rumor or not, the key point is that policy is moving toward treating silver as reserve relevant. And when sovereign entities enter a market, they are not flipping it next week. They are removing supply from circulation. They're adding a persistent layer of demand. Then there's China, and this is the part that should grab your attention, even if you don't follow politics. China moved to tighten controls on silver exports beginning January 1st. So you have a major producer and consumer effectively saying, we'll be more selective about what leaves our borders. That's not a casual tweak. That's a strategic posture and fits a broader pattern seen across multiple commodities. Countries want critical inputs at home. So step back for a moment. US labels it critical. Russia allocates reserve buying. China restricts exports. Different motivations, same outcome. More competition for a metal already in deficit. Now we get to reason 3, where market mechanics can turn a tight market into an urgent market. Backwardation. Most people never discuss backwardation because it sounds like something only traders care about. But the concept is simple. Normally, futures prices rise the further out you go. Why? Because if I'm to receive a commodity later, someone must store it, insure it, and finance it. Those costs push future prices slightly higher. The typical upward curve is called contango. Backwardation is the reverse. The curve flips. Near-term delivery costs more than later delivery, and that signals the market is saying, I want metal now, not later. And in late 2025, silver's futures curve pushed into unusually deep backwardation. Near contracts traded at a premium of several dollars versus later contracts, a type of inversion associated with historical stress points. Why should you care? Because backwardation can reflect 3 things: supply stress, surging physical demand, or breakdown in usual pricing and settlement comfort. Sometimes it's a combination, but the real effect is psychological. When traders and buyers see that inversion, they stop thinking, maybe I'll buy later, and they start thinking, why are people paying extra for it now? And that creates urgency. It becomes a feedback loop. If everyone wants physical now, I want it now too. It's the same dynamic as a bank run. Most people don't run because they enjoy running. They run because they see others running. Now, I am not here to give fantasy targets or claim a line on a chart guarantees a price, but I want you to understand long-term context. People love quoting the old nominal high from 1980 as some magical ceiling, but nominal highs ignore decades of inflation. Adjusted for inflation, that old high looks far higher than most realize. And technicians studying multi-decade base patterns argue silver has spent years building a massive foundation capable of supporting much higher pricing over time. I'm not saying that automatically occurs in 1 year. I'm saying the ceiling many cite is not as low as they imagine. And that matters in 2026, because if the market shifts from paper comfort to physical urgency, repricing can look irrational until you remember scarcity drives price, not opinions. Now, reason 4 quietly feeds every scarce asset rally: loose monetary policy. In late 2025, the Federal Reserve said it would stop runoff of securities holdings starting December 1st. If you followed recent years, runoff was part of tightening, so ending runoff is a pivot back toward normalization. In modern finance, normalization has a reputation. It tends to mean easier conditions over time. It tends to mean rate cuts arrive faster than expected. And it tends to mean when something breaks, liquidity responses faster. Now, stopping runoff is not instant money printing, but it removes a headwind. It shifts stance. Precious metals don't need perfection. They need marginal changes favoring scarcity. On top of that, policymakers' signal rates are likely to move lower in 2026. Even if forecasts change, the message is the peak is behind us. And that matters because lower rates reduce opportunity cost of holding metals. It also pressures real yields. And when real yields fall, scarce assets tend to reprice upward. Bigger point. With high debt and sensitive economies, central banks favor stability over tightness. So looking at 2026, ask, do you expect policymakers to remain tight all year? Or the usual pattern? Something breaks, response eases. If easing occurs, silver responds aggressively because it's a smaller market and flows move it faster. Reason 5, volatility, but be careful. Volatility isn't why silver rises. Volatility is how silver moves. It transfers metal from weak to strong hands. It punishes impatience, rewards planning. Volatility can occur across regions. Late 2025 gave a perfect example. A large premium opened between Shanghai pricing and Western venues like COMEX. Historically, spreads don't widen much because arbitrage closes gaps. But gaps of $6 or more indicate pipes are clogged. Moving metal isn't frictionless. Physical matters. Incentive exists to move metal from cheap to valuable. Incentives aren't easy execution. Shipping, timing, settlement constraints exist. Frictions can keep spreads wide longer than expected. Reports noted buyers approaching producers offering above market rates. First offers $8 above, then higher, when $10 above. Interesting. Who bid? Manufacturers. I need this to operate. Traders. Market mispriced. Both together, necessity and speculation stack, volatility expands. Even leveraged products show wild positioning. Largest inflow into double leveraged short ETF, followed by largest outflow, not calm conviction. Panic, whiplash, forced exits. Volatility within volatility. Watch silver in 2026 with a plan surviving noise. Silver rips, dips, headlines loudest. Narratives, familiar pattern. Stories claim it's over. Commentary warns crash. Sell now, this time is different. But message, exit before next move. Pullbacks occur. Question: are constraints easing? Structural deficit ending? Governments less interested? Fiscal urgency gone? Export controls reversing? Policy tighter? If no, pullbacks are part of process, not the story's end. Mid-video detour, silver success stories, real case studies using metals to build wealth. Link in description. Subscribe. Real examples help rationality. Connect 2026. Silver performed well. Inventory buffer thinner. Governments treat silver as strategic. Futures show stress. Central bank policy eases. Global dislocations. Confirm physical premiums. Dangerous for waiting. Best moves occur when entry looks worst. Chart extended. Premiums annoying. Mainstream voices say crowded. Next leg hits. Late buyers pay more. Straight line? No. Silver is staircase, broken steps. Climb, drop, sudden jump. 2026 has virality potential. Shocking moves attract attention. New buyers tighten physical. Tighter conditions feed backwardation. Premiums loop. Your turn. What dominates 2026? Industrial or investment demand? East-west premium wide. What breaks first? Paper confidence or physical holders' willingness? Drop answers below. Comments shape coverage. Final reminder. Stay ahead, subscribe. Biggest mistake? Arrive post-move, risk higher, upside smaller. Wishing strong week, take care, see you next video. Volatility is the price of admission.